Hi, this is Zanny and E bringing you the best financial advice so that you can achieve financial freedom. Did you know that there are 7 investment assets that are far better than traditional cash holdings in which you can invest to create wealth? Top personal finance books such as Rich Dad, Poor Dad by Robert Kiyosaki, The Total Money Makeover by Dave Ramsey, and The Intelligent Investor by Benjamin Graham emphasize the importance of these assets in creating wealth and breaking free from the rat race of working for a paycheck. Please stay tuned as I explore each one in detail. 1. Precious metals. I am involved in the precious metal business, where I buy gold from alluvial miners and sell it to other businesses and individuals or create gold bars. Based on my experience, I can tell you that it is a very lucrative business, and there are multiple reasons why you should invest in precious metals like gold and silver rather than keeping your money in your bank account. Precious metals serve various essential roles in investment strategies. Firstly, they function as reliable stores of value, evidenced by their historical use spanning centuries, particularly during economic uncertainty or periods of inflation where they retain their worth remarkably well. Gold, for instance, has demonstrated consistent purchasing power over time. Secondly, precious metals, notably gold, are viewed as effective hedges against inflation, appreciating in value as fiat currencies weaken, thus safeguarding your purchasing power. Moreover, they serve as safe haven assets during geopolitical turmoil or financial crises, offering stability due to their detachment from governmental or central bank influence, minimizing currency devaluation risks. Finally, incorporating precious metals into investment portfolios would enhance diversification by mitigating risks. Their low correlation with conventional assets like stocks and bonds allows them to potentially perform independently, thereby reducing overall portfolio vulnerability to market fluctuations. As an investor, you have several avenues to engage in precious metal investments. One option involves acquiring physical bullion, such as gold, silver, or platinum, through trusted dealers or mints, typically in the form of coins, bars, or ingots. Alternatively, exchange-traded funds, ETFs, offer a convenient route, allowing you to track precious metal prices through ETFs that either hold physical metals or derivatives contracts. Another approach involves investing in mining stocks, which entails buying shares in companies actively involved in exploring, extracting, and producing precious metals. If you are interested in trading, futures contracts and options on commodity exchanges provide avenues to speculate on precious metal prices and hedge against market risks. 2. Industrial commodities. Industrial commodities are raw materials that are essential for various industries and manufacturing processes. These commodities include metals like copper, aluminum, and zinc, and energy resources like crude oil, natural gas, and coal. These commodities serve as building blocks for the production of goods and play a crucial role in global economic activity. The demand for industrial commodities is primarily driven by industrial activity, infrastructure development, construction projects, and technological advancements. And as emerging economies continue to grow and urbanize, the demand for industrial commodities tends to rise, reflecting increased consumption of goods and expansion of manufacturing sectors, therefore, making them perfect investments for investors like you. Investing in industrial commodities presents compelling reasons beyond high demand, notably for diversification and inflation hedging. Industrial commodities, such as copper and aluminum, provide diversification advantages to investment portfolios by exhibiting low correlation with conventional assets like stocks and bonds, thus enhancing risk management strategies. Moreover, these commodities historically serve as potent hedges against inflation, as their values tend to appreciate alongside the rising prices of goods and services, thereby safeguarding investors' purchasing power over time. To sum up, studies have shown that investing in industrial commodities can offer attractive risk-adjusted returns over the long term. Research conducted on commodity markets indicates that industrial commodities exhibit unique characteristics compared to financial assets, making them valuable additions to diversified investment portfolios. 3. Safe haven currencies. Safe haven currencies refer to currencies that investors perceive as stable and reliable during times of market turbulence, economic uncertainty, or geopolitical tensions. These currencies are sought after by investors seeking to preserve capital and mitigate risk during periods of volatility in financial markets. The primary characteristics of safe haven currencies include stability, liquidity, and a strong reputation for maintaining value relative to other currencies. For example, the Swiss franc is a prominent safe haven currency known for its stability and neutrality. Switzerland's strong economy, political stability, and reputation for financial integrity contribute to the Swiss franc's status as a safe haven asset. As a result, affluent individuals prefer to keep their money in Swiss banks. Additionally, during the 2008 financial crisis, a substantial amount of funds flowed into Switzerland from multiple countries. Therefore, if you are considering investing in a superior currency, you may want to consider the Swiss franc, British pound, or Chinese yuan. There are a couple of ways you can get access to safe haven currencies. For example, currency ETFs and forex brokers can allow you to gain currency exposure with as low as $100. In conclusion, safe haven currencies would play a vital role in your portfolio as a means of preserving capital and managing risk during periods of uncertainty. Understanding the characteristics and drivers of safe haven currencies, as well as their performance relative to other assets, can help you make informed decisions and navigate volatile market conditions. 4. Sovereign guarantee. Investing in sovereign guarantees, such as government bonds or treasury securities, would offer you a fundamental pillar of financial stability and security. These investments are underpinned by the full faith and credit of the government, providing a robust assurance of repayment compared to bank deposits, which may entail inherent risks depending on the stability of the banking system and regulatory oversight. For example, in times of financial distress or economic turmoil, the stability of banks can become precarious, potentially exposing you as a depositor to losses beyond the protection provided by insurance programs. Therefore, government bonds are widely regarded as one of the safest investment options, particularly in stable economies with established political and economic systems. Investment in sovereign guarantees is even explored in some of the top personal finance books. For example, The Intelligent Investor by Benjamin Graham underscores the paramount importance of safety and security in investment decisions. Graham, often hailed as the father of value investing, advocates that investors should prioritize the preservation of capital above all else. While Graham primarily focuses on stocks and bonds in his book, his principles of safety and security resonate deeply with the rationale behind investing in sovereign guarantees. By adhering to Graham's principles, you can navigate market uncertainties with prudence and fortify your portfolios against unforeseen risks. So, if you are seeking to safeguard your capital and preserve your wealth over the long term, consider investing in sovereign guarantees. 5. Value stocks and mutual funds. Value stocks and mutual funds represent two prominent investment avenues for you if you are seeking to grow your wealth over the long term. Value stocks are shares of companies considered undervalued by the market, often possessing strong fundamentals but temporarily out of favor due to various factors. As an investor in value stocks, you will need to employ strategies rooted in fundamental analysis to identify opportunities where market prices diverge from intrinsic values. Notable books such as The Intelligent Investor by Benjamin Graham advocate for value investing, emphasizing the importance of purchasing stocks at a discount to their intrinsic worth, thereby potentially realizing significant gains over time. Mutual funds, on the other hand, pool money from numerous investors to create diversified portfolios managed by professional fund managers. These funds offer instant diversification across various asset classes, reducing individual investment risk. Some mutual funds specialize in value investing, targeting undervalued stocks to capitalize on market inefficiencies. Noteworthy titles like Common Sense on Mutual Funds by John C. Bogle elucidate the benefits of mutual fund investing, stressing the advantages of professional management and diversification for individual investors. Investing in value stocks and mutual funds would offer you several compelling advantages over traditional savings accounts. For example, historically, value stocks have demonstrated the potential for higher returns compared to growth stocks, making them attractive for investors seeking capital appreciation. Mutual funds provide accessibility to a diverse range of investments, managed by experienced professionals, potentially outperforming individual stock picking. Moreover, value stocks and certain mutual funds offer income generation through dividends, which can supplement your cash flow and provide financial stability. Compared to keeping money in bank accounts with minimal interest rates, investing in value stocks and mutual funds would offer you the potential for wealth accumulation and inflation protection. While investing involves inherent risks, you can mitigate these risks through thorough research, diversification, and a long-term investment horizon. Ultimately, by understanding the principles of value investing and mutual fund strategies, you can make informed decisions to grow your wealth and achieve your financial goals over time. 6. Land and real estate. Investing in land and real estate often emerges as a compelling alternative to traditional bank accounts due to several key reasons. First, real estate has historically demonstrated the potential for appreciation, unlike funds and bank accounts that typically yield minimal interest. Personal finance literature underscores real estate as a tangible asset with the propensity to increase in value, particularly in sought-after locations or during economic upswings. This appreciation potential would provide you with the prospect of capital growth over time, which exceeds the returns generated by conventional savings accounts. Moreover, real estate offers avenues for income generation through rental payments. Rental properties furnish investors with a consistent cash flow stream that can be utilized for various purposes, including covering expenses, reinvesting in additional properties, or diversifying one's investment portfolio. The income derived from real estate investments often surpasses the interest accrued from bank accounts, enhancing the attractiveness of real estate as an investment vehicle. Furthermore, land and real estate serve as effective hedges against inflation. In times of rising living costs, property values and rental prices tend to escalate, which means it would enable you to preserve the purchasing power of your investments. Additionally, real estate investments provide tax advantages not available with bank accounts, including deductions for mortgage interest, property taxes, depreciation, and other expenses associated with property ownership and management. Leveraging options through mortgages would further amplify potential returns by enabling you to control substantial assets with relatively modest initial capital outlays. These combined benefits underscore the enduring appeal of real estate as a viable investment avenue. Top personal finance books consistently advocate for real estate as a cornerstone of a well-diversified investment portfolio, with titles such as Rich Dad Poor Dad by Robert Kiyosaki, The Total Money Makeover by Dave Ramsey, and The Intelligent Investor by Benjamin Graham emphasizing its significance in wealth accumulation and financial independence. Moreover, empirical research in finance substantiates real estate's potential to outperform conventional investments like stocks and bonds over extended periods. Historical data demonstrates that real estate offers competitive risk-adjusted returns and functions as a valuable diversification asset within investment portfolios. Therefore, if you have cash laying around in your bank account, considering investing in real estate could be a prudent strategy, provided you conduct thorough research and due diligence to mitigate potential risks and maximize returns. 7. Collectibles. Investing in collectibles presents a unique opportunity for diversification beyond traditional asset classes like stocks and bonds. One of the key reasons you should consider collectibles is their potential for high returns over time. Categories such as rare coins, art, vintage cars, and rare wines have demonstrated the ability to appreciate significantly, offering investors a chance to capitalize on unique market dynamics. Moreover, some collectibles, such as precious metals, serve as a hedge against inflation, which means adding them to your portfolio would help you to preserve purchasing power during periods of economic uncertainty.